Okay, this is part of this Burton Sensors case, and as I said, I'm using this case to work through my book. I'm using this case to illustrate how to build models, but most important, how to make valuation analysis, and in this case, valuation analysis in the context of mergers and acquisitions. Now, what they did is they gave you nice, simple kind of numbers. So we're supposed to be looking at acquiring this company called Electro Engineering. Okay, and the key thing here is that you're allowed to buy this company at uh, uh, 10 times EBITDA, EBITDA, 10 times EBITDA. Okay, we're going to buy it at 10 times EBITDA. Is it worth doing? Now, they put all these kind of vague things that they could grow its sales. They gave you a sales growth number, and they said they could reduce the SG&A cost, and they could reduce the cost of goods sold percentage. Let's see if we, am I recording? I think I am. Yeah, let's see if we can make a model of this in minutes. So the title of my video, I hope, is going to be Corporate Finance Model with three statement corporate finance model in minutes. Now, what they did is, in this case, they gave you a very simple historic 3 years of history. They gave you 3 years of history, and they gave you the three statements. Ooh, cool, three statements. So I've done some of this. Now, if you're gonna, so here's if you want to try this yourself, here, and this file is in that page. The first thing to do is we're going to make a little forecast, okay? And in fact, I think they gave you some of the data in the forecast, and then we got some history, and let's understand how we'll set this up. We've got some three statements of history: income statement, balance sheet, cash flow statement. Now, once you have the history, you set up a little switch. Okay, we set this up and we go forward, and we set up a little switch that says if it's I'm going to do this because this switch is so important. We say this one is less than or equal to the history. We press F4, Shift Control B, because I've got generic macros, Shift Control R. Okay, and once we have our three statements in here at the top, I suggest leaving it in one page. You can debate me on silly things like this. And then we'll put, if it's the historic switch, then we go upstairs and we take our sales divided by our prior sales. And if you want to put -1, fine, -1, and that's our historic growth rate. Okay, now this time, so we only have two historic growth rates. This time I'm going to cheat. Now in the careful model, I set up a very careful input C and an input S page where we have sales growth scenarios and everything. That's for the acquiring company. But for this one, let's just cheat. Okay, and this is not good form. I feel a little bad about doing this, but screw it, because the reason. Oh, see, it says it's exclusively for me. This case. And they said she thinks they're not operating efficiently. Now we have a big pile of bullshit already in this case. And she said, this woman said, okay, we're going to grow by 24, 17 and a half, 15, and 12. So let's just input those. Now those should really be input in a separate case, in a separate place. And what were they? Oh shit. Okay, 24, 17 and a half, 15, and 12. Okay. 24%, 17.5%, 15%, and 12%. Let's put 10% after that in case we want a couple more years. Okay? So we have some sales growth, and then we do the same thing. So then, we say if it's the historic year, go up to H10, and H10 is the net sales up here. Otherwise, if it's not the historic year, then take the sales growth times our numbers. Okay, here. And then we can put our cost of goods sold percent, and our cost of goods sold percent is again, if it's the historic year, now they did a nice little thing in this silly little case, then you take this divided by that. Okay, that's what we can do for historic numbers. And then they gave us some other numbers to put in. And they said, oh, okay, cost of goods sold, where is that? 51 down to 49%. So we're just going to make their 49% assumption. Shift Control R. And then everything, this time you just say, you can multiply it together. You could make absolutely sure. And then we'll do the same with the SG&A percent. I'm sick of this already. SG&A is supposed to be down to 23.86, and it looked like after that they were going to do everything here. So this time what I had done is I said, well, if it's not the historic year, take the last one, but this time we'll put 23.86, I think. Is that what they did? Something like that. I don't even care. And then for these other ones, we took if it was the historic period, and I hope you're seeing the value of the historic switch. Otherwise, I just took the history. Now, when you press Shift Control Shift Alternate C, Shift Alternate C, then we're just gonna let's color the sheet and let's make sure we show the inputs. Okay, and let's put some things at the top. We've got 7 at the top. Okay, and this is eating into my time, but I don't care. Just to illustrate kind of how we're doing things. Okay. Okay, so we've got our all of our inputs in some funky little blue color, and we put those assumptions in, and then the next part of getting this 3-statement financial model down is to do it a little more creatively with depreciation, capex, and this, you notice they didn't even do anything with these idiots. Okay, and they got their case completely wrong. Everything falls apart now. We just get the historic depreciation. Control down here. We've got the historic depreciation. Then we go down and get the historic PP&E, and then we go down to the capex and get the historic capex. And we put those things together because that's the big assumption, and that's where everybody goes wrong in these models, because we have to see how much investment we can make. And we have historic depreciation, historic capex. I just grabbed those. Historic PP&E, and we look at capex as a function of depreciation, about 2 times, 1.5 times depreciation. We get capex as a percent of sales, which they probably wanted us to use, which is just bullshit, but we'll use it. And then we have capex. We can multiply this by our sales like we've done everything else. So we get a forecast of capex And then for the depreciation rate, I would use the opening balance of the PP&E and compare that depreciation. 70% depreciation. What are they? Maybe the only thing they own is iPhones, and some of these people have to be silly enough to destroy the environment by saying I need a new iPhone every 2 years. But this is an incredible depreciation rate. What it really means is people got everything wrong. But this is the big deal. We make an opening balance and a closing balance. We can put in our depreciation on our CapEx historically, but the big deal is to use an if statement here. And if it's the historic year, then you go up and just take the closing balance of the PP&E. Otherwise, if it's not the historic year, you take the opening balance plus the CapEx minus the depreciation, okay? And then you can, make a really nice smooth transition from the history to the projection, because here we've just made a projection, and then we got all the working capital. So for the working capital, you just take the percentages. I took everything as a percentage of sales. We put a historic number, and if it's not the historic number, we go back to the prior one. So you can see the importance of this little historic switch. And then we can multiply all these by the sales. Perhaps I should have put the sales up here so you can see what they're all multiplied by, and then you can get the total current assets, total current liabilities, and the total working capital, and get the difference change in the working capital. So now let's get to the point where I really stopped, and I wanted to show you what's really happening, and that's with the debt financing, and that's to make a model where the blah 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 to make a model where the if I could get one word out, that would be great. Where the balance sheet balances, basically. So on this one, we have if it's the I took the interest expense divided by the opening balance, because that's how we're going to do the model to make sure it's not a circular reference. And if it's not the historic year, let's do it again. If it's the historic year, like that, then we take the interest divided by the prior debt balance. Otherwise, we go back and take the prior interest rate. So there's their little 5.5% assumption. And then we make an opening debt, and we do the same thing. If it's the historic year, then take the opening debt plus any new debt issue minus any repayment. But we are going to get that from the cash flow. Otherwise, if it's the historic year, if it's the historic year, take the actual debt you have on the balance sheet, which I just took from the balance sheet up there. Otherwise, take the opening balance plus the issue minus the repayment. Okay? But these two things we're going to fill in. Now, I've got all my, up here, we worked through our revenues. We just worked through the income statement. We got the revenues, cost of goods sold, R&D. We've got everything before financing. We're almost really ready to go with the model, almost ready to make a valuation without a financing of enterprise value. But let's get this, and let's put the equity balance in here too. Opening, and let's add the new equity issue and less the dividend. I add the income rather, less dividend, and we get a closing balance. I can't talk and type at the same time. And we do the same thing. I just want to emphasize this trick is so cool and so important. If it's the historic year, go up and take the historic balance of the equity. Otherwise, take the opening balance plus any issue of new equity plus any income minus any dividend. Now, we might, and make the opening balance here equal the prior year closing balance. Shift Control W. If you ever use a paintbrush, you're an idiot. Sorry to be that blatant. Okay. Now I think we should also put, if just in case, if we had any, we could have some surplus cash like Apple has, the billions. Opening surplus cash, add new cash, cash generated. Now I'm not. What I did, I should have told you before. Less cash used, closing balance. So what we can do is we're going to have kind of an order. If we have positive cash flow and we have some cash on our balance sheet that's surplus, not the cash we need to run our operations, and we're not going to get obsessed by this BS of what's operating and not. So far, I put everything in the history as operating. I treated it like an accounts receivable up there. If the cash is negative, we're going to use some of the cash. If the cash is negative and we've not got any cash left, we're going to use a minimum statement and we're going to have to issue new debt. If the cash is positive and we have some new debt, we're going to repay it. But if we have no new debt left, we're going to put it on the balance sheet. All of these things, we're going to make an opening balance equal a closing balance. All of these things are from this time I'm just going to make it, let's just make it, if it's, we're just going to do this really in the future. So if it's the historic year, I'm going to put 0, otherwise that's kind of cheating, but this one plus the new cash generated, I hope you don't mind that. I'm just illustrating these key points, which is to finally get a really good framework to work through the income statement and the balance sheet. Now, we have the other thing we don't have quite yet is a tax rate. Now, they've given us up here, if it's the history, then let's take the pre-tax, the taxes divided by the pre-tax income. So this is an ancient case and they have a 35% tax rate. If it's not the history, just go backwards and take the prior one. Okay, so we can make this model really in minutes. And so after we have EBIT, we're going to get our interest. Now, when we get our, and let's finish this off, and then we can have pre-tax. We could put EBT, and then we could get our that's earnings before tax or pre-tax income less, and we're not going to worry about deferred taxes or something crazy like that. And then we have taxes, and then we get our earnings. That earnings is going to go back upstairs. This is where we go upstairs and downstairs a little bit. Now, for the debt, we can then put our interest expense. So we'll just like any kind of model, you will take our opening balance times our interest rate. But if we want to really be careful, let's put if it's the historic year, and that's where we completely go crazy with this historic switch. Then we do this, otherwise we do nothing. Shift Control R. We get that in there, and so now we can go down and fill in our interest expense. I tried to pick a kind of a case where we can do this quickly and not kind of make you just tortured by watching too much, and then we can take this number multiplied by this. So I would encourage you, if you think you're going to have any kind of test, or even if you're an MBA student or something like this, to try to make these kind of things. It's not that hard. And then we have our earnings, okay? And Shift Control G. And use the generic macros, please. So now we can put in, now I have our cash flow. I started with EBITDA. We take away, and I think it's probably a good idea to make these negative, you know. And then we don't really care about the history as much here. We care much more about the forecast. And we have those CapEx I just talked to you about before. And then let's go to the financing cash flow and stick in our interest expense. Okay. And then once we stick in our interest expense, we could put some debt retirements, but I didn't. Let's not put that in. You know, this debt balance that they now have, this debt balance, they could have some scheduled retirements that we're going to have to finance. So I'm going to, just to illustrate that, we'll put less. Oh no. How about up here? We'll put less scheduled retirements. Now you could easily when you do this kind of stuff, you could easily blah blah blah. I can't get words out, but you could split up the debt. You could put existing debt, new debt, short-term debt, long-term debt, but there's got to be one debt issue that captures the cash flow. And that's what we're doing here. So now we're not going to put this, and then we could even put less dividends, but they had no dividends. If you look at it, so our net cash flow, let's just put our net cash flow that we're going to do something with. This doesn't look like a cash flow statement exactly, but we'll have this plus this. Now, I should have put this as a negative and the next one as a negative and the next one, and I'm just going to do that in a minute. Shift Control R, put a minus here, okay, and we have this, and Shift Control Q to make it nice and pretty. And what happened here is kind of interesting. We have this much cash flow, and unless I don't think I've done anything wrong, we'll check everything. We have this many income taxes, and we have some operating cash flow. We take away the CapEx, take away the interest. This is the amount of cash flow we have left. So I'm just a little bit worried about the history, but okay. But now we're going to see what to do with this cash flow, and I'm only going to worry about the future. Okay, and let's put positive, and we'll make another scenario, cash flow, and we'll just use a maximum statement. But first, put if it's not the history. Okay, then let's put maximum of this or 0. And if it's positive cash flow, and if you want to press Shift Control B, Shift Control R, you can get it. So we have this positive cash flow, and we have to do something with this positive cash flow, and we're going to make it negative in a minute. Now, if there's positive cash flow, the first thing we're going to do is cash used to pay down debt. Now, you could do all sorts of things, but this is the kind of basic number one starting point. And we're going to take the minimum of this cash flow, or the opening balance of that debt we had up here, this opening balance up here. So the first thing we're going to do is pay off the debt. And then we so far it looks like we paid it all off, but then we go back up to this and we say, okay, we're going to pay off this debt down here because we had positive cash flow, and we're going to get the debt. All right, and so what happens here is once we copy this across, then we paid off all the debt in the first period. So then we can, after that, we can almost do a little cash flow waterfall, but we don't need to. And cash build up after, now this is just the way they set up this case so badly, it's mind-boggling because of that 2-year depreciation, and it's just mind-boggling how badly this is the logic and the realism of this case is. But we'll come to that in just a minute. Cash buildup after debt paydown. I like the case because it's got all sorts of things, and we can just take this cash minus this one. That's what's left over. It's like a little bitty cash flow waterfall, and then you go upstairs and you see, well, how much surplus cash do we get, and we put that in. Now, okay, and then all right, and let's put that in. Now, to make this a little more interesting, let's pretend, let me get this formatted. If you wanted, you could put interest income and all that crap in here now. But okay, so they're building up all of this extra cash, but let's go up here and now change the cost of goods sold percent, and up here, let's make it go up to, so they have a couple good years, and then it goes up to 70%. Okay, so they have a really bad year, and let's make it 70% in 2 years. Okay, so I'm just making it have some negative cash flow. So after we put this in, I hope we go down to our profit and loss statement, and now we have 50 of EBITDA, and we still are making our capex, which would be an idiotic thing to do, but whatever. And then we have some taxes, which we made as positive. Let's just cheat with the taxes. And this is a criminal to do this, but put maximum, because you should have a tax carry forward, but put a maximum of that of 0, and that just cuts off the taxes. So let's just put that in so we get some good negative cash flow. So this time we built up some cash, but now we've got negative cash flow, and we've got to first pay down the debt. So let's put negative cash flow, and we're going to do something else. So the first thing is, let's put if it's not the historic period, then we're going to take we'll put a maximum, but this time put a minus on the maximum of this, or 0. Okay, so whoops, and I forgot to put this in because I'm going too fast. Hope that Shift Control B, Shift Control Q, Shift Control R. So that now we have to get some cash. And where are we going to get the cash? Well, we built it up here. So the first, let's put use of, and the only way to do this is to think about it and talk to yourself like I'm talking to myself. I hope I'm talking to one person maybe. Use of surplus cash. So we do the same thing, and we say take the minimum, not this one, put an equal sign, take the minimum of this number or the opening balance of our surplus cash, which was right here. Okay? And we put that in. Now, maybe you're going to pay a dividend, and you're going to maybe have some fancy little calculations for paying a dividend, and you can put that in, and that dividend's going to come out of here, or you're going to retire some existing debt. All that stuff can be before, but then you can kind of get it down to this action. But here we did this, and then we've got to go back, and I know it sounds like we're going back and forth and making your head spin, but it's really not that bad. You just go downstairs, and on all these changes, you have to take these straight from the financial statements, and you press Shift Control R, and then we've paid down our debt, and then we're building up paid down our cash, and then we're building up some cash. But we've got another problem here, and the other problem is that we need to get some extra cash, and then we put cash, borrowed debt, borrowed for deficit cash or something like that. Okay, and that's going to be up there, and we just take this minus that, and this, it sounds so simple when I'm doing it. I can tell you I did this wrong for so many years, and made it more complicated than it needed to be. Once you kind of go through the four little parts, once you go through the four little parts, you can connect the income statement and the balance sheet and get your three statement modeling done really fast. So we put this in, and so now we've had to borrow more money, and then before we use that other cash, but we're gonna pay it off again. So we had to borrow money in two periods. Our cash flow went up, our interest went up because our cash flow went up, and now everything should work. Okay, and we've reconciled everything, and we don't have to put any cash used and cash balance at the end. Now we've got a model, and let's put our balance sheet together. Now I'm going to kind of cheat, and I'm going to put current assets, including minimum cash, and then let's put surplus cash. How about we'll put surplus cash at the top. And then what we have, of course, is we have all of our accounts, and we so the surplus cash is up here. We had nothing in the history, and then on our current assets, we did all of this stuff where we put the historic switch in. I combined them all. I can't stand it when you did this, and I hope we put our working capital change here. Okay, and then we have our net PPE, and that's basically, I don't think we had anything else on this nice simple little case. That's why I used this case. Now it could be a gigantic case, but who cares? And now you put the history together with the forecast, and then you get hopefully our total assets. Okay, and let's press alternate equal. And when the balance sheet doesn't balance, you notice I said when, I didn't say if. When it doesn't balance, and then we have current liabilities. Okay, and we put our current liabilities in here. I wonder what I should call this video. Okay, and then let's put our debt balance, and that's what this thing. Now you could, like I'm repeating myself, but you could split this between short-term debt and long-term debt and all that stuff. So we're putting our total debt balance. Maybe I should have put a little underline there. And then we've got our equity balance. Now, when we go up to our equity balance, we have to fill that in too. So we put in the history, but now, and we don't have any new debt issues, and we don't have any dividends. The only thing we have is our earnings, really. Okay, and that doesn't matter. You know that this closing balance here, this closing balance of equity, that's not affected by this because that's in the historic switch. It just takes that. And oh, we had the big negative numbers still. Oh, good. Okay, why not? Okay, and then we free up storage space. Oh, I've got to do something here. Okay, oh, shoot, because I make videos on this computer. Oh no, it's gonna. That's what's going on. I see. I saved it. Okay, so let's get the equity balance, and let's see if the balance sheet balances. Now, if this equity balances, it's just because it's really easy. And if it doesn't balance, well, it's typical anyway. So we look at the historic year. It balanced in the historic year. And I haven't even looked at it yet because I'm wasting my time pressing Shift-Control-G to put an underline in. And let's put difference. Okay, so the first thing to test is did we do it? And it looked like in the second historic year we have it right. Oh shit, we don't have it right. Okay, now let's see if we can find this 278 real 276. Where is 276? Taxes. And I didn't put the taxes, I put as a negative. I didn't put it in the subtotal here. So it wasn't that bad, was it? But it shows you kind of, and then if I put the taxes in, that kind of changes a lot. And then this didn't exactly work, but you know what we could do is put equal round of this to 0 equals 0, okay, and then we can put a equal and that's, I'm stopping the video right now because I'm going to talk about the important thing from this case later on, but in a prior or a subsequent video. But I want to make sure that you see this method of kind of putting doing the financing and connecting all the financing. That's how you can efficiently make a corporate model. And now I got to go and free some space up apparently. Okay, all right, and one of the shorter videos I've ever made. Fantastic.